Good morning. I apologize, everyone, for the technical difficulties that we're having this morning. I recognize that we are 20 minutes late into the session, but I will do my best to run through this as quickly as possible and not waste anyone's time. But overall, we find ourselves in a position where the major equity markets, the S&P 500, is effectively back near all-time highs after what has been a very sharp sell-off here a few weeks ago. Pretty resounding recovery we have seen since that sell-off. And the question for most investors at the moment is whether or not this market can break out higher from these all-time highs and continue moving higher, or is there the risk that we are near major resistance and we are likely going to start pulling back and perhaps trade in a more neutral trading range going forward? I think a lot of that is going to be embedded into the NVIDIA earnings tomorrow. We have certainly seen investors take a lot more of a cautious tone with regards to AI related stocks, semiconductor stocks in terms of their recovery have not been there in relation to the rest of the market. Um, and we have a lot riding on the NVIDIA earnings coming out tomorrow. Any concerns that NVIDIA has in terms of softness on guidance for the rest of the year or any time going forward is likely going to be taken negatively by markets. However, if let's say NVIDIA continues to exceed earnings expectations and provide guidance that they expect demand to remain strong, that is potentially the catalyst that the equity markets need to break out to new all-time highs. So I would say a lot is contingent upon the NVIDIA earnings coming out tomorrow. You have the NASDAQ 100 that is back to previous resistance, but not at previous highs. As you can see, a little bit of weakness here from the technology focused NASDAQ 100. We are finding ourselves just shy of the 50-day moving average on terms of a pullback. And the question is whether that 50-day moving average will hold as support or we start to see some further weakness here from some of these names going forward. So we'll take a look at other charts to try to answer that question here. IWM still not quite back to that double top all-time high here, but making some progress here, continuing to outperform the S&P 500 quite a bit over the last week or so. And even the RSP equal weight S&P 500 index did manage to print a new all-time high yesterday. At least intraday, we managed to print a new all-time high. So we do have equity markets that overall look like on this recovery, the rally has broadened out, which is generally a positive thing for this market. But however, that in itself is not quite enough to justify equity markets continuing moving higher. But the fact that we have a broadening out of this rally overall is a positive tone for the overall markets. If you look at Russell 2000 growth versus value, we have seen growth outperform value for the past year or so. But over the last couple of months or so, we've seen a pretty substantial outperformance of value over growth. That reversed here during the rally back from the sell-off a couple of weeks ago. But over the last few trading sessions, we continue to see value outperform growth. Especially as we kind of get back to these all-time high resistance levels. And again, that is not necessarily a bad thing for the overall market to see a bit of rotation here as kind of the high-growing tech stocks take a bit of a back seat for the rest of the markets to play a little bit of catch-up. And when we look at the individual sectors, we'll see that play out a little bit more here in a few minutes. Commodities did manage to stage a rally back to major resistance levels and actually break out above those levels. You now have a small resistance here at 2160 or so, which corresponds to the 50-day moving average. A breakout higher from here would be fairly constructive here for the for gold. That would start to print a series of higher highs and higher lows. That could be the start of a reversal higher here for commodities. So that's one I think is worth paying attention to in terms of asset class. In terms of bonds, we continue to see bond markets provide a risk on signal. The high yield bond market continues to grind higher to new relative highs on HYG. If you look at the bond yields between investment grade versus high yield, it continues to decline, which favors kind of a risk on environment here. So when we look at across the board and you look at commodities, you look at bonds, you look at VIX, what's interesting about VIX is that even though equity markets are continuing to tick higher here, you have a little bit higher, VIX ticking higher here alongside with that. And that really reflects investors perhaps a little bit more fearful of markets as they reach back to these all-time high levels. Concerns that there is some further downside from here. We certainly have seen hedging costs as we return back to these all-time highs be higher than the last time we were at these all-time highs, right? If you look at kind of where the VIX was, if you look at where the VIX was, if you look at where the VIX was prior on the last high, we were substantially lower here in terms of VIX. So hedging costs were substantially lower the last time we were here. So markets are a little bit more fearful, a little bit more concerned about potential downside given where we have been a few weeks ago, which is understandable. And again, I think NVIDIA earnings will be a big part of potentially reducing some of that volatility or expected future volatility after earnings on NVIDIA comes out tomorrow. You have the 10-year yield moderating, kind of hitting a bit of that low around 3.8%, finding a bit of a floor here. A small bounce here yesterday. We'll see if that can continue moving higher here. You saw TLT break out above this $94 level, come back to retest as a resistance and continue to move higher from there. That's largely constructive here for bonds, but we did manage to get back to some recent highs that it has so far struggled to kind of get back above those levels here right now. So we've seen rates moderate a little bit as a result of that resistance that we've seen. The dollar index did manage to kind of tag a one-year low just a couple of trading sessions ago. Expecting a bit of a short-term bounce here for the US dollar, I think is reasonable. But long-term, the risk here is that the dollar breaks below this double bottom here around this $100 level. And that would be a very bearish signal here for the US dollar. And given the outlook of interest rates for the US dollar versus other currencies, a weaker dollar is certainly something that is in the cards at the moment on a longer term basis. And then if you look at kind of gold, we continue to see the gold remain constructive here. The breakout above 2450 has been fairly constructive here for a continuation higher here. And that's part of what's been driving commodity prices higher alongside this triple bottom here around 72 on oil has consistently been a good buying opportunity for oil. We've seen a pretty substantial move higher here from 72 to 77 in just a couple of trading sessions. This still has a little bit more upside room to grow in terms of oil prices. And then when we take a look at the individual sectors, technology has really started to fall behind here a little bit in terms of relative strength. And that strength has kind of slowly moved its way into sectors like consumer discretionary, even communications. We see a little bit of outperformance here. You see financials have managed to break above this $44 level here to the upside, followed by some outperformance here as well. So you have a lot of sectors that are starting to look very constructive here. Consumer staples, breaking out to recent highs with relative performance. You see the same thing in terms of healthcare, breaking out above 152 with a little bit of outperformance here. You have materials starting to break out higher above this double top here around 93 with outperformance. You You see the same thing in terms of industrials doing the same thing, breaking out to new all-time highs. You see real estate breaking out to new all-time highs with outperformance. So across the board, we're seeing kind of this strong outperformance here. So a lot of the sectors that have been lagging behind playing catch up here, which overall is actually a good thing for the markets. You also have home builders playing a huge amount of catch up here over the last couple of trading sessions and outperforming the markets. The only thing that's underperforming is semiconductors. Notice the 50-day moving average sloping lower here, risking semiconductors moving lower from here, underperforming, getting rejected, the 50-day moving average, 58-day moving average sloping lower here, really suggesting perhaps there is some downside risk here for semiconductors. So overall, you have a really positive tone here for equities. You have a lot of different asset classes that have supported a risk on environment. You look at the sector rotation, you're seeing a fair amount of rotation with leading sectors kind of falling behind a little bit and the rest of the market playing catch up, which is overall a positive tone for the equity markets. And then you have semiconductors kind of the biggest risk here right now. So that's worth paying attention to, especially with NVIDIA's earnings on deck for tomorrow. With that, again, I want to apologize for the late start and the technical difficulties with getting started. I apologize for that, but hopefully that gives you a clear overview of how we're viewing the markets going forward. With that, thank you so much, and I hope you guys have a great trading day.